Thinking about buying your first investment property or maybe adding another one to your portfolio. It is an exciting step. Real estate is arguably the most powerful wealth builder available to the average person. But here is the reality check. It is only a wealth builder if you buy the right asset. Too many new investors get caught up in the emotional side of buying a home. They walk in and look at the granite countertops or the paint colors or the nice backyard. But as an investor, you cannot think like a homeowner. You need to think like a bank. You need to look at the data. Today, I am going to break down the 4 non-negotiable pillars of a winning single-family investment home. If you stick to this criteria, you minimize your risk and you maximize your long-term returns. Let's dive in. First up, and you have heard it a million times, is location. But let's get specific. I don't just mean a nice neighborhood. I am talking about the specific trifecta that drives tenant demand. Number 1, schools. Now, you might think, hey, my potential tenant might be single or they might be empty nesters. It doesn't matter. Homes in top-rated school districts historically hold their value better during downturns. Plus, tenants with children tend to stay longer. They do not want to pull their kids out of school mid-year. That means less turnover for you. Number 2, proximity. We live in a convenience economy. How close is the home to major highways? Can your tenant get to a grocery store, a pharmacy, or a coffee shop in 5 to 10 minutes? If a tenant has to drive 20 minutes just to get milk, that home will be harder to rent. And number 3, companies. You want to invest where the jobs are. Look for homes near major employment hubs, tech corridors, or corporate campuses. When people move to Austin for work, they want a short commute. If you buy near the jobs, you will always have a pool of qualified applicants applying for your property. Next, let's talk about the house itself. This is where a lot of new investors make critical mistakes. Configuration matters more than pure square footage. You want to look for the sweet spot, which is typically a 3-bedroom, 2-bath home. I often see investors chasing 4-bedroom, 2-bath homes under 2,000 square feet. I advise against this. Why? Because when you squeeze 4 bedrooms into a smaller footprint, the rooms feel tiny. Tenants walk in and realize their queen-sized bed won't even fit in the guest room. A tenant would rather have 3 spacious rooms than 4 cramped ones that they can't use. And here is a specific configuration detail that is worth its weight in gold. Try to find a home with at least 1 bedroom and a full bathroom downstairs. This is huge for marketability. Maybe your tenant has an elderly parent living with them who cannot do stairs. Maybe they use it as a home office and want separation from the family upstairs. Or maybe they just hate climbing stairs after a long day. By having that downstairs suite, you open up your rental pool to a much wider demographic. The third pillar is something called rental velocity, or simply how fast does it rent. Before you make an offer on a house, you need to know the stats. You need to know the average days on market for rentals in that specific neighborhood. Vacancy is the silent killer of cash flow. Think about it. If a home sits empty for 2 months because the demand isn't there, that is 2 months of mortgage payments, utility bills, and lawn care coming directly out of your pocket. That can wipe out your entire profit for the year. We want to see homes renting in 15 to 30 days. If homes in a neighborhood are sitting for 60 or 90 days, run away. You want high demand areas where tenants are fighting to get in, not areas where for rent signs gather dust. And finally, the most important number of all, cash flow. In today's market, with interest rates and home prices where they are, you have to be realistic, but you also have to be safe. Your goal is positive cash flow. This means the rent covers the mortgage, property taxes, insurance, HOA fees, and puts a little money in your pocket each month for repairs. But at the absolute minimum, you need to be at break even. Do not, and I repeat, do not buy a property that forces you to pay hundreds or thousands of dollars out of pocket every single month just to keep it. That is what we call negative cash flow. Some investors do it, banking on appreciation, hoping the home value goes up enough to cover the losses later. But that is gambling, not investing. If the market turns, or if you lose your job and you are bleeding $500 a month on a rental property, that asset becomes a massive liability very quickly. So remember the list. 1. Good schools and proximity to jobs. 2. The right layout with spacious rooms and downstairs access. 3. Fast rental times. And 4. Positive cash flow. If a property checks all 4 of those boxes, you have found a winner that will pay you for years to come. If you want to analyze a deal together or just run some numbers on a property you are eyeing, send me a message. Let's build your portfolio the right way.